Hello everyone and welcome back to the sessions on Advanced Strategic Financial Management. Friends, in continuation of the topic Advanced Capital Budgeting Part 1, today in this class we are going to learn about decisions regarding timing of replacement of assets. If you can recollect, in the previous class we have learnt about decisions regarding replacement of assets. That is basically whether an existing asset should be replaced or not. So we learned how to decide whether an asset should be replaced with a new asset or not. However, another important question that comes is when this replacement should be carried out. When? Timing. So if I can take you back to where we have learned things in topics like share valuation. Suppose you find a share in the stock market which is worth investing. So you find that fundamentally it is strong and you should buy that particular security. You should invest in that particular share. That is the fundamental analysis of a stock, right? The technical analysis of that stock will give you inclination towards the timing when should you invest in stock market, correct? So the decisions always come in two phases. One is whether you should invest or not, and then when you should make that investment. Entry in the stock market and exit in the stock market has to be planned very well. Otherwise, even if you pick up fundamentally a very strong stock, but you may end up making losses if the timing of entry and exit is not planned properly. That is why your decisions cannot be just restricted to which stocks you should buy and not, which stock you should include in your portfolio. You have to also decide when should you make that investment. Exactly similar way, when in any business situation you have decided that you should replace your existing asset with a new one. Then comes the point, when should you make that replacement? I'll tell you real life examples because what I see in my business. For example, this camera which I am facing right now, this has tendency to turn off on its own sometime. Very good quality camera, but it has that tendency to turn off on its own and again it turns on. This disturbs my recording process. So in my mind, I have a need to replace this camera with a new one which will be definitely an upgraded and better version. But many factors will influence my decision about when should I replace. Number one, the availability of funds. Number two, availability of the product in the market. Number three, other factors like whether I'll be getting some replacement value for this existing camera or not. All these factors can influence my decision about when should I make this replacement. Now you tell me one thing, should my camera decide when it should be replaced or should I decide when to replace my camera? It is me who is going to decide. My equipments cannot decide when they are supposed to be replaced, correct? So some students may ask me, sir, what do you mean by when can camera decide? See, every equipment, every asset will have a maximum useful life. Once you have utilized that asset fully to its end life, then there is no more utility of that asset. The asset will stop working one day, and that time I will be forced to replace that asset. In that case, it is not me who decided when to replace the asset. It is the asset that is deciding when it should be replaced. Remember guys, it is always the business management that should decide when to replace the asset. Assets cannot decide. Who are assets to decide? Correct? Who are assets to decide? This decision cannot be taken by assets. These decisions have to be taken by the person conducting the business. In my case, it is me. So I just gave you an example. So this replacement from my side is yet due. Sooner I'll be replacing this camera. But when exactly is going to happen, that I have plotted in my own Excel sheet. Now, I don't want to go deeper into that example because certain things are still my secret which I cannot share with you people. Now, coming to the concept, decisions regarding timing of replacement is very important, because once you have decided in your business that your asset needs to be replaced, you have to parallelly decide one more thing: when should you replace that asset? And therefore, in exam, the decisions regarding replacement of assets also play a vital role. Now, what kind of scenarios you are going to face in exam? You will be facing a scenario of determining optimum replacement cycle of an asset. I repeat, it is optimum replacement cycle of an asset. So what do we mean by optimum replacement cycle of an asset? Let us suppose an asset's overall life is 3 years. So after 3 years the asset will stop working and you will have to replace it. So then 3 years is the maximum waiting period. You cannot use the asset beyond 3 years, that is definite. But you may choose to replace the asset maybe at end of second year, or maybe by end of the first year itself. For example, if an asset has overall life of 3 years, then its replacement cycle can be once in every 1 year, or once in every 2 years, or once in every 3 years. Keep in mind one thing very clearly: these are capital budgeting decision, and the minimum time period that you consider is 1 year, and the gap between your timing has to be one year. So it is either at end of every 1 year, or at end of every 2 years, or at end of every 3 years. So what we do, we identify all the cost and benefit, including scrap value, initial cost, all components of inflow and outflow over the lifespan of the asset that we have considered in that decision, whether it is 1 year, 2 years, or 3 years. And we identify the present values of all these cash flows. So we got 3 different present value figures for 1 year, for 2 years, and for 3 years. But because the time horizon of all the 3 decisions are different, what you should do, you should annualize these present value figures. And if these present value figures indicate a net outflow, you should try to minimize the outflow. If it is an inflow on a net basis, you should try to maximize the inflow. But when you annualize, the present value gets converted into a per annum amount, and the annualized present value or equivalent annual value will be the indicator of what will be best timing for replacement of that asset, and that is how we can come across optimum replacement cycle of an asset. Now understand one thing: while you do this, there can be 3 possible scenarios that can come in your exam. Number 1, what I just explained, that there is a single asset and you just have a need to identify the optimum replacement cycle of that asset. Task done. The way I have explained to you, you can do it like that. When we take up calculative examples, you will definitely develop better understanding. The second scenario could be, there is one existing asset and there is a new asset given to you, and the information about new asset is given very clearly in terms of its initial cost, in terms of its utility, etc. And how long you are going to use that new asset is also reported. That means you are not supposed to identify the optimum replacement cycle of that new asset. Instead, what you have to decide, if the existing asset has a remaining life of 2 years, you have to decide whether you should replace that new asset now. That means whether you should replace that existing asset with the new asset now, or after 1 year, or after 2 years. So how do I summarize that scenario? I summarize that scenario this way, that you don't have to take any decision about the new asset. You have to decide only one thing: when the existing asset to be replaced by this new asset. Now, most important thing, sometimes a third scenario may arise in exam, that they have given you information about an existing asset as well as a new asset. first thing that you will have to do is determine the optimum replacement cycle of the new asset, because the question did not mention how long we have decided to use that new asset. And then also decide when should you replace the existing asset with the new one. So there will be three different scenarios, and I am going to give you calculative examples for each of these scenarios one by one. So be careful when we are handling these calculative examples. Those will give you complete insight about what exactly has to be done. So what we do first is we first write some important notes about what we have just discussed, and then we proceed ahead. So based on what we have just discussed, please write under the heading optimum replacement timing. Replacement of assets has been a significant decision under capital budgeting. Decisions regarding whether an existing asset should be replaced or not has already been discussed earlier. Once decided that the asset should be replaced, the next decision making problem is regarding the timing of replacement, that is, when the asset should be replaced. There can be three possible cases of information that can be provided in the question. So before I take you to those three cases, quickly write up this much what you find on screen. Alright friends, once you have completed writing this much, let us move ahead and talk about those three cases. Case 1. There is only a single asset and the objective is to determine its optimum replacement cycle. Case 2. There is an existing asset which is proposed to be replaced by a new asset. The replacement cycle of the new asset is given in the question, and the requirement is to find out the appropriate timing of replacement of the existing asset with the new one. So write up this much, and then I bring forward the third case. Alright friends, once you have completed writing these two cases, let us move ahead and talk about case 3. Here you write, there is an existing asset which is proposed to be replaced by a new asset, and the replacement cycle of the new asset is not informed in the question, whether it is directly or indirectly. The requirement is to find out the optimum replacement cycle of the new asset and appropriate timing of replacement of the existing asset with the new one. So please write up this case as well, and then I take you ahead. Alright friends, once you have completed writing these three cases, let us move ahead and start taking up calculative examples. First we take up an example on the very first case that will be given in question number 13 of your book. Let us read this question. Cost of the asset is rupees 1 lakh and its life is 3 years once installed. Its repairs and maintenance cost on annual basis will be as below. Year 1 rupees 20,000, year 2 rupees 25,000, year 3 rupees 30,000. The asset can be disposed of at any of the following dates. End of third year, salvage value will be rupees 10,000. End of second year, salvage value will be rupees 40,000. End of first year, salvage value will be rupees 60,000. Therefore, the management requires the optimum replacement cycle for this asset, whether 1 year or 2 years or 3 years. Discounting rate is 10% per annum. Now, if you can observe, the whole question gives you information only about one single asset. When there is information about only one single asset, you need to just determine the optimum replacement cycle. So we have just three choices: either replace the asset at end of every 1 year, or at end of every 2 years, or at end of every 3 years. Now these three decision points, 1 year, 2 year, 3 years, because these are different times, in other words, each decision has a different life, you are supposed to use the concept of annualization, because when you convert all these cash flows to their present value, for 1 year present value, for 2 years present value, for 3 years present value, it cannot be directly compared. each present value will be converted into equivalent annual cost or annualized amount of outflow. Now if you observe, they have given you cost of the asset as the initial cost. It is already at the present value. Year 1, year 2, year 3, these recurring costs you can convert to their present values if you are deciding to replace the asset by end of third year. That is why you will be incurring all the three costs, and then the salvage value you will be recovering at the end of third year. So 1 lakh will be your cost, 20,000, 25,000, 30,000 will be your cost, and at end of third year this one salvage value you will recover. Convert everything into their present values and finally annualize that present value over 3 years period, so that you get equivalent annual outflow or annualized outflow per annum. If you choose to replace the asset by end of second year, do you know what you will do? You will consider this 1 lakh, you will consider the repair and maintenance cost of year 1 and 2, you will not consider this third year cost, then you will consider the salvage value to be recovered at end of second year, that is 40,000. Convert all these cash flows to their present value, and because the net amount will be an outflow, divided by annuity factor for 2 years, and you get the annualized outflow for each of the 2 years. However, if you decide to replace the asset at end of every 1 year, you will incur this 1 lakh of initial cost and then repair and maintenance cost of year 1 only, and you will recover the salvage value by end of first year. That's all. So when you convert all these cash flows to their present value, 1 lakh is already at present value. Determine the present value of this repair and maintenance cost for 1 year only, and consider the salvage value at end of first year, convert that into present value. These will be present values for 1 year time period, so annualize it just by 1 year. Now you will be getting 3 different amounts of annualized outflow. Compare the 3, whichever is the lowest, go ahead with that. So let me show you how to present the solution over here. In your solution, you first begin with calculation of annualized net outflows if the asset is replaced once in every 3 years. So you make a table. When you make this table, you start with the year 0, 1, 2 and 3. Now keep in mind one thing, because you have decided to replace at end of every 3 years, you will be incurring the cost for each of the 3 years. Initial cost, however, will be incurred only at the 0 year, never ahead, because that is the initial investment required. So you put that cost as 1 lakh for year 0, dash 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 for 1, 2 and 3. Recurring cost, as I said, will be appearing in each of the 3 years. Scrap value will arise only at end of third year, because you have decided to replace it at end of third year. Now initial cost is an outflow, recurring cost is also an outflow, this scrap value is an inflow. So in the next column we are computing the net outflows: 1 lakh for year 0, 20,000 for year 1, 25,000 for year 2 and 30,000 minus 10,000, that will be net 20,000 for year 3. The PV factors for 0, 1, 2 and 3 years at 10%. You can plot these PV factors and convert these net outflows into their present values by using these present value factors. The net outflow converted to their present values can sum up to 1,53,869, which we are identifying as total PV of outflow over 3 years. This much present value of outflow is arising over 3 years, divided by the annuity factor for 3 years at 10%, and when you divide 1,53,869 by annuity factor for 3 years, look at what you get. You get the annualized net outflow, that will be rupees 61,873 per annum. Now when you go with the second possibility, you will Again write the heading as calculation of annualized net outflow if the asset is replaced once in every 2 years. You make similar table, but in that case make year column just as 0, 1 and 2. Avoid writing this line simply. Then this 1 lakh will come, 20,000 and 25,000 will come, this 30,000 won't come, this 10,000 also won't come. Instead, the scrap value that is realizable at end of second year will come. Then you compute the net outflows, identify PV factors, convert the outflows to their present values, find the total, divide it by the annuity factor for 2 years, and you will obtain the annualized net outflow for the 2-year period. You have to keep doing that for all the possible outcomes over here. So before I take you to those other possibilities, quickly write up this entire working. Alright friends, once you have completed writing this entire working, let us move ahead and now deal with the second possibility, that is calculation of annualized net outflow if asset is replaced once in every 2 years. So here what you do, you make the similar table, and as I said, you plot the years only up to 2 years. Initial cost will be incurred at 0 year. The recurring cost, which were repairs and maintenance cost, will be incurred at year 1 and 2 only, because you are not going to use the asset for the 3rd year. The 3rd year repair and maintenance cost won't arise, but because you are going to dispose of the asset at end of 2nd year, you will realize the scrap value at the end of 2nd year. So determining your net outflows for 0, 1 and 2 years, converting that into present values by using the PV factors at 10%, we get the total PV of outflow over 2 years as 1,05,785. Dividing that by the annuity factor for 2 years at 10%, what you get is annualized net outflow, which is rupees 60,952 per annum. So please write up this working as well, and then I take you ahead. Alright friends, once you have completed writing this working, let us move ahead and deal with the last possibility. Here we would say calculation of annualized net outflow if the asset is replaced once in every 1 year. Same kind of table, nothing different, but do you see the number of lines that you are putting in the table is getting reduced, correct? Now it is just year 0 and 1. So initial cost will definitely come only at 0 year. Recurring cost will come only for year 1. Scrap value will be realized at end of year 1 itself. Net outflow at 0 year will be 1 lakh, and at first year end it will be negative 40,000, because you are getting more of inflow and less of outflow. Converting this into present values using the PV factors at 10%, the total PV of outflow is coming to 63,636, but we have to annualize this as well. Now many students ask me a doubt that, sir, this is already for 1 year, no? Why are we going to annualize this? Keep in mind one thing. This is the present value. Present value means you have converted this value at 0 year. We would want this on the basis of per annum, and when I say per annum, for each year it is at the year end. So what is at the beginning of the year, just try to convert it by end of the year. So annuity factor for year 1 at 10% will be simply the PV factor for 1 year, and annualized net outflow would come to rupees 70,000 per annum. So before we conclude the scenario, just write up this working quickly. Alright friends, once you have completed writing this working, let us move ahead and conclude the scenario. We will say the annualized outflow is lowest when the asset is replaced after every 2 years. So we would conclude optimum replacement cycle shall be 2 years. So means the best thing for the company would be to replace the asset once in every 2 years. So please write up this conclusion and then I take you ahead. Alright friends, once you have completed writing this conclusion, it was end of the solution for that question. Let us move ahead and take up the next question, that will be question number 14. Let us read this question. A and company is contemplating whether to replace an existing machine or to spend money on overhauling it. A and company currently pays no taxes. The replacement machine costs rupees 90,000 now and requires maintenance of rupees 10,000 at end of every year for 8 years. At end of 8th year, it would have salvage value of rupees 20,000 and would be sold. The existing machine requires increasing amount of maintenance each year and its salvage value falls each year as follows. Now they have given you present and year 1, 2, 3, 4. Now maintenance cost at present will be 0. Year 1, 2, 3, 4 each year you will be having maintenance cost. This is again a recurring kind of cost, and salvage value what is given over here, you can get salvage value of either 40,000 or 25,000 or 15,000 or 10,000, and it will be 0 if you use this existing asset for 4 years. The opportunity cost of capital for A and company is 15%. When should the company replace the machine? So what do we find in this question exactly if you focus? Look at the information regarding the new machine. They are so clear about one thing, that the new machine once installed it will be used for 8 years and then it will be sold. That means you are not supposed to make any decision for the new machine, correct? It is only about when should you replace this existing machine with the new one. So what is the remaining life of this existing machine? 4 years. Now how many possible outcomes you can have? You can replace the existing machine with the new one immediately, that means immediate time, now 0 year, or you may decide to replace it after 1 year from now, or after 2 years from now, or after 3 years from now, or after 4 years from now, which is the maximum possible life of the existing machine. In total we have 5 decisions possible. Either replace the existing machine with the new one now, or after 1 year, or 2 years, or 3 years, or 4 years. 5 decisions. Each of these decisions will have time period of 4 years. That is the existing machine's remaining life. In simple words, the remaining life of the existing machine will be the time horizon for all the 5 decisions. So what you do is, you find the equivalent annual outflow of the new machine first based on the information of new machine, but you don't have to define its replacement cycle. Replacement of the new machine will be done once in every 8 years, that is decided already. You just find its annual cost, that is its effective annual outflow or equivalent annual outflow. Once you find its annualized cost, then you take any decision. For example, you decide to replace the existing asset with the new one after 2 years. Your total time horizon of the decision will be 4 years. First 2 years you will use the old asset, and next 2 years you will be using the new asset. Suppose you decide to replace it after 3 years, then for first 3 years you continue to use the old asset, and then for the 4th year you use the new asset. As simple as that. If you decide to replace it immediately, for all the coming 4 years you will be using the new asset only. If you decide to replace it after 4 years, for all the 4 years you will be using the old asset only. In simple words, all 5 decisions will have same time horizon, 4 years, 4 years, 4 years. So at the end, then you don't have to find the annualized inflow or outflow. You just understand this is the second case where You don't have to find the optimum replacement cycle of the new asset. You just have to decide on the optimum timing when the existing asset to be replaced by the new asset. So let me help you with how to present your solution over here. In your solution, the first thing that you have to consider is the annualized outflow or equivalent annual cost of the new machine. For this purpose, you get started with the cost of the new machine now and add the present value of repair and maintenance cost on a recurring basis. Look at one thing, the repair and maintenance cost is given as rupees 10,000 per annum for 8 years. Now, one thing is already informed in the question that this new machine will be used for 8 years and then it will be sold. That means the question has already given you the replacement cycle of the new machine. So, new machine's replacement cycle is not a question mark. It is already informed to you. So, you have identified the present values of these outflows, and when you take the total of that, you subtract the present value of salvage value at end of 8 years. So, at end of 8th year, you will be getting rupees 20,000 as salvage value, and that you multiply to the 8th year factor and you will be getting the present value of the salvage value. Because this is going to be an inflow, you subtract it and your net outflow in today's terms comes to 1,28,335. Then what you do is you determine the annualized net outflow or equivalent annual cost, which will be the present value of outflow divided by the annuity factor for 8 years. So please write up this entire working and then I take you ahead. Alright friends, once you have completed writing this working, let me explain you what you need to do with this calculation. Whenever you are using the new machine, its annualized outflow, its equivalent annual cost is rupees 28,600 per annum. That means including the initial investment, its repair and maintenance cost, running cost, and considering its salvage value at end of 8 years, all components consolidated in this working. Every year you use this new machine, you are having effective outflow of 28,600, correct? 28,600 every year. So you just need to consider that when you are using old asset, you take the facts and figures of the old asset. In whichever place you are using the new asset, just put 28,600 over there. Let me help you with that calculation as well. The solution further goes this way. So starting with the first alternative, we would say calculation of total PV of net outflow if the existing asset is replaced immediately. Now you make this table and carefully understand what you need to do. In year column, you will plot all the time points that will be starting from 0 year till 4th year. So 0, 1, 2, 3, 4. Recurring cost of existing machine. Now look at one thing. You are putting the heading if the existing asset is replaced immediately. Recurring cost of existing will not arise at all because you have chosen to replace the existing asset immediately. So nothing will come over here. So just put dash 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 in the entire column for each time point. On the other side, the annualized cost of new will come for year 1, 2, 3, 4, all the 4 years. Why? Because you have decided to replace the existing asset with the new one immediately, and as a result you will be getting the annualized cost of new machine in each of the 4 years. So it will be dash in 0 year and then 28,600 for each of the 4 years. Now someone will again have a doubt over here. They would ask me, sir, why didn't we consider the initial cost of the new machine? Guys, understand, this confusion should not arise in your mind, because while computing this 28,600 in the earlier working, the initial cost of the new asset was already considered. the scrap value of the new asset was already considered. The recurring cost of the new asset was already considered. So basically all the components of cost with respect to the new asset have been considered, and that is what we have converted into an annualized cost or an annualized outflow. Whenever the new asset is being used, annually you will consider a cost of 28,600, end of the matter, for the new asset. So all the remainder information what we have to consider is for the existing asset, but for the existing asset we have put dash 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 only because we are not using the existing asset under this alternative. So scrap value of the existing asset you will recover at 0 year itself because you have decided to replace it immediately. Now this is your outflow, this is your outflow, this is your inflow. So your net outflow can be computed, and convert this net outflow into the present value using the PV factors at 15%. When you make this calculation, you will be getting the total PV of net outflow as 41,653. Now over here we don't need to make any annualized calculation. I have explained you earlier. Once again I am telling you, because each of the decisions what you are going to consider will have a time horizon matching with one another. As a result, time horizon for each of your 5 decisions being same, you are not going to annualize this amount. You will keep it as it is in the form of present value over the next 4 years. So please write up this entire working and then I take you ahead. Alright friends, once you have completed this entire working, let us move ahead. And now what we do is we write up similar heading, but now we consider the possibility that the existing asset is replaced after 1 year, not immediately but after 1 year. Now you make exactly similar kind of table. The format of the table will remain same. In the year column you will still plot 0, 1, 2, 3 and 4. Now you have decided to replace the asset with the new one after 1 year. That means for 1 year you are definitely going to use the old asset. So the recurring cost of existing asset will arise for the first year. So you just put 10,000 in the first year, and in all other time points you put dash dash dash. Now keep in mind, because in the first year you are using the old asset, the annualized cost of new asset will come only for second, third and fourth year. So it will be dash dash and then 28,600 in each of the later 3 years. Scrap value of existing asset, now you will recover not at 0 year but at end of first year. And keep in mind one thing, scrap value will come only once in this entire column depending upon which point you are disposing of the old asset. So compute the net outflows, and when you compute the net outflows, convert these into present values using the PV factors at 15%, and you get the PV of net outflow over the period of 4 years, and this time it comes to 43,738.44. As again, the annualization is not needed over here. Why? Because all your decisions have same life, so annualization further is not needed. Annualization was needed only for the new assets cost. So quickly write up this working and then I take you ahead. Alright friends, I am sure you have completed writing this entire working. Let us move ahead and take up the next alternative, that will be if the existing asset is replaced after 2 years. Now you will make exactly the similar table. I don't have to explain you again and again, and you plot the years as 0, 1, 2, 3, 4. Now you have decided in this possibility that you will replace the existing asset after 2 years. So for 2 years you continue to incur the cost with respect to the old asset, which will be 10,000 in the first year and 20,000 in the second year. And for the later 2 years, that is year 3 and year 4, you will be incurring the annualized cost of the new asset, that will be 28,600 in the later 2 years. Scrap value of the existing asset you will recover at the end of second year. Find the net outflows for each time points, convert these into their present values, and once you get the total, it will be the total PV of net outflow that comes to 47,634.48. So please write up this working and then I take you ahead. Alright friends, once you have completed this working, let us move ahead and now explore the next alternative, that is what will happen if the existing asset is replaced with the new asset after 3 years from now. So in this possibility, for the first 3 years you will be using the old asset. So recurring cost of existing will come for year 1, 2 and 3, and annualized cost of the new asset will come only for the 4th year. Scrap value of existing asset you will recover at the end of 3rd year, and you compute the net outflows and convert these into their present values. It is the same calculation that you have to do every time, just the possibilities and hence the amounts are changing. So write up this entire working and then I take you ahead. Alright friends, once you have completed this working, let us move ahead and explore the last possibility, that will be total PV of net outflow if the existing asset is replaced after 4 years. If you have decided to replace the asset after 4 years, do you know what will happen? For each of the 4 years, you continue to incur the cost of the existing asset only. That will be 10,000, 20,000, 30,000, 40,000 for year 1, 2, 3, 4 respectively. And the next column, annualized cost of new asset, will not come up to end of 4th year at all. Why? Because till 4 years you are using the old asset only. Scrap value of existing will arise at the end of 4th year, but it is given as 0. Net outflow you identify for each year, convert these into their present values, and when you identify the total, it will be total PV of net outflow over a period of 4 years if you have decided to continue to use the old asset for the next 4 years. So write up this entire working and then I take you ahead. Alright friends, once you have completed this working as well, time for us to draw the conclusion. We would write in the conclusion that the total PV of net outflow is lowest when the asset is replaced immediately. Therefore, the company should replace the existing machine with the new machine immediately. So please write up this conclusive point and that will be end of this solution. Alright friends, once you have completed writing this entire conclusion, let us move ahead and take up the next question, that will be question number 15. Let us read this question. It says, ABC Limited has a sheet cutting machine which may be replaced by a new machine now or after 1 year or at the most after 2 years. The cost structure of the existing machine as well as that of new machine is given below. Now can you see, they have given you details about the existing machine and they have also given you the details about the new machine, and they say that the firm has a discount rate of 12%, and first thing they have asked is what is the optimum replacement cycle of the new asset, and then they have asked you what should be the when should the existing asset be replaced by new asset. So here you have information about the existing machine as well as new machine, where how many years the new machine will be used is not defined, because the question itself is asking you to find the optimum replacement cycle of new asset. So how will you approach the solution to this question? First thing what you will do is you will obviously find the optimum replacement cycle of the new asset. Then you consider these information and work it out, and then only you should touch the information about existing machine. Mind it, even if the question sequence is altered, for example, if they first ask you when should the existing asset be replaced by new asset, and then they ask you what is the optimum replacement cycle of the new asset, still you would make this calculation first. Without optimum replacement cycle of new asset, you will not be in a position to answer this question which is asked in the second part. So let us first do the first thing, that is determining the optimum replacement cycle of the new asset. Over here you will begin with calculation of annualized net outflow if the new asset is replaced once in 3 years, that is once in every 3 years. Now these calculations I don't have to explain you. The way you have done the optimum replacement cycle calculation earlier, exactly same way you have to do this. And this is all about the new asset information only. Here we are not using any piece of information from the existing asset. This you have to do independently just with the information of the new asset. So you first find the total PV of outflow over 3 years and then divided by the annuity factor for 3 years to arrive at the annualized net outflow. You may also call it equivalent annual cost for the new machine. And now once you get it for each of the 3 decisions, then you are going to use that information for deciding when should you replace the existing asset with the new one. But first you write up this working quickly and then I take you ahead. Alright friends, once you have completed writing this calculation, let us move ahead, and now the next heading will be calculation of annualized net outflows if the new asset is replaced once in every 2 years. So same presentation, you will just pick the data for 2 years. Keep in mind one thing, initial cost is incurred only once, recurring cost will be incurred as many years as you are using that asset, and scrap value will also get realized only once, that is at its termination. Here the termination is happening at end of 2 years. Then you work out all other calculations in the usual manner and you arrive at the present value over 2 years divided by the annuity factor to get the annualized net outflow. Here in this case it is rupees 23,177 per annum. So please write up this calculation and then I take you ahead. Alright friends, once you have completed writing this calculation, let us move ahead and make one more calculation of this type with the heading calculation of annualized net outflow if the asset, that is new asset, is replaced once in every 1 year. Same format of presentation, but now you will take the data only up to 1 year for this new asset. So scrap value what you realize will be at end of the very first year, and your calculation of present value, you divide it by the annuity factor for just 1 year, and annuity factor for 1 year and present value factor for 1 year both will be always same because it is just cumulative PV factor for just 1 year. So it has to be the PV factor of the first year. So please take note of this whole thing and then I take you ahead. Alright friends, once you have completed this calculation, what we now do is we compare the annualized net outflow of each of the 3 decisions and we conclude that the annualized outflow is lowest when the asset is replaced after 2 years. Therefore, optimum replacement cycle for the new machine or new asset will be 2 years. Write up this conclusion for the first part of the question and then I take you ahead with the next part. Alright friends, once you have written this conclusion, mind it, it is not the end conclusion for the entire question. This is only for the first part. So what you have concluded in the first part, that the new machine should be replaced after every 2 years. So whatever will be the annualized outflow for 2 years, that you should consider for the next part of the decision ahead, that is when should you replace the existing machine with the new one. When you decide that, that is the time when you have to consider this information about the annual outflow, that is annualized outflow at end of 2 years. What we found in the previous decision, that is the decision when the new asset should be replaced every 2 years, whatever be the annualized cost over there or annualized outflow over there, that you have to consider when you are comparing the cash flows of the old and new asset. So let me take you ahead with the later part, which you have learned in the previous question already. Just look at this. The first heading will be calculation of total present value of net outflow if the existing asset is replaced immediately. Here you are replacing the existing asset immediately, so there will be no information picked up from the existing asset. Look at the recurring cost of existing, I have put dash dash dash. Instead, the annualized cost of new asset will be taken as 23,177. Now what is this 23,177? This was the equivalent annual cost or annualized net outflow for the new asset, because we have decided that the new asset will be replaced once in every 2 years. That is why I told you, first you must always find the replacement cycle of the new asset when it is not informed to you, and then only you should come up with this decision of when to replace the existing asset with the new one. And then you work out everything in the usual manner. What you have learned in the previous question, now it is exactly to be done that way. So one last thing that I would recommend, that here the final amount of net outflow what we obtained, we are not going to annualize this any further, because the next decision what I am going to consider will be again calculation of total PV of net outflow if the existing asset is replaced after 1 year. Over there what you will do, you will use the existing asset for 1 year and the new asset for 1 year. And in the third decision, where you are going to replace the existing asset with the new one after 2 years, for both the years, that is year 1 and year 2, you will be using the existing asset and you will not consider the new asset at all. That means in each of the 3 scenarios, your decision point will be 2 years, 2 years, 2 years. That is why you don't need to annualize these net outflows. So quickly write up this working and then I take you ahead. Alright friends, once you have completed writing this working, let us move ahead, and now we take the other decision, that is we determine the PV of net outflow if the existing asset is replaced after 1 year. So same format of presentation, just one thing, that for the first year of its existing life you will use the old asset, and during the second year you will be using the new asset, and accordingly you consider the scrap value and other factors. So your calculation this time comes to 27,406. So please write up this as well and then I take you ahead. Alright friends, once you have completed writing this calculation as well, let us move ahead, and now we write up the last part of the decision, that is PV of net outflow if the existing assets are to be replaced after 2 years. So you again have the same format of presentation, but this time you will be using the information about the existing asset only. In the new asset column I am just putting dash dash dash, because for the next 2 years you are not touching the new asset in this decision. So you work out your net outflows and convert these into their present values. Your present value of net outflow here comes to rupees 33,817, and we find that the lowest present value of net outflow is coming when you are replacing the asset after 1 year from now. So you conclude that the existing machine should be replaced with the new machine after 1 year from now. So that will be your final conclusion. Write it up, and that will be end of this solution as well as end of this session.